You're tuned into the Money Show, and today we're going to be touching with a very interesting topic with our special guest for today, Shweta Rajani, Head Mutual Funds at Anand Rathi Wealth, because we believe that there are a lot of investment options that are available for you, and people generally go about choosing the right fund for, in terms of, they're always confused about, there's so many opportunities when it comes to the mutual fund space, whether to go for a pure play equity or a debt play, or you can also mix with another asset classes as well. Let's find an answer to that. And to answer all of this, we are being joined by Shweta. Very good evening, Shweta, and thank you so much for your time. First of all, we're going to be touching about and wanting to know that between the large cap, between the debt and the equity side of the investment, which one to go about and how to go about it. But how does the past data suggest that how can the pure play equity and debt mutual funds can reward the investors in a better fashion in comparison to the hybrid funds that are available?
Sure. Just like you said, let's go with the past track record first. If we go with, how Nifty would have performed over the last few years, and you'd see Nifty delivers an average 12% return. If I look at a 3-year rolling track record of equity funds, you can expect equity funds to give you that 2-3% more. So you'll find equity funds giving you returns in the range of, anywhere between 14 to 16%. Debt, if I look at, debt, it's more relevant to see what's the current yield I'm getting if I'm investing in debt. Debt gives generally around the 6.5-7% return. And there's also gold, because when I'm talking about multi-asset allocation funds, they tend to invest in a combination of equity, debt, gold, and very recently they've also started silver. But gold has primarily been the investment vehicle. So a 3-year rolling gold return also shows it's been in the range of 7 to 8%. But this is just the return part of it. In finance and while doing investments, while you're looking at returns, it's equally important that you look at the risk as well. And one measure for risk is standard deviation. So if I look at the standard deviation, right, a debt fund could have a 1% of standard deviation. Equities could see around 11 to 12%. Gold, on the other hand, we've seen standard deviations being in the range of 6 to 7%. So what I'm trying to say is while gold may give you returns which are more debt-like, at a lot of times their volatility in the returns could be more equity-oriented. This is generally been the track record of these three asset classes if you're looking at. So now it becomes important that you first determine what asset allocation is the most relevant for you to achieve your goals. Srishti.
Thank you so much for putting all this in perspective and telling our viewers that how can the pure play equity and debt mutual funds can reward the investors in a better fashion. But coming specifically to the equity side, Shweta, how does one should go about it? Because a lot of times people are confused that whether to go for a pure play large cap, small cap, maybe a flexi cap category. So what's your sense that how should they go into investing in the equity side, and what should be the strategy there?
Sure. I would say, it's a 2-step process. In the first step, it's important to determine what should be your market cap allocation, which means how much of the money should go into large caps, which SEBI defines as the top 100 companies, how much in mid cap, which is the next 150 companies, and how much in small cap. Now, what you need to look at is factors like valuations, factors like, what the earnings potential or the return potential is looking like for each of these categories. Like today, if you ask me, I would say 50% of a large cap allocation and maybe a 20-25 mid, 20-25 small is a good allocation to go ahead with in your portfolio. So that's the step 1 decision. The step 2 decision then becomes which categories of funds you should look at to get the desired market cap allocation. Let me, again, give you certain data points here. If I see the last 5 years and I look at a pure play large cap fund, which tends to have 90% of its money invested in the top 100 companies, the average alpha it would have delivered to a Nifty 50 benchmark would be around 3%. A flexi cap fund, on the other hand, also tends to have 70 to 75% invested in large cap funds, but the average alpha they would have delivered would be around 4.5, 5%. So if you've chosen to have 50% of large cap allocation in your portfolio, you're better off being in a flexi cap category than the large cap category. So, that's how step two is seeing which category has more return potential, or, how it's played out in the past. That can help you determine which category you should be in. Likewise, if you're looking at mid and small, you have an option of going in for pure pay mid or a small cap fund. You have categories like a multi cap fund, also that you can choose, to invest into. So look at each of these and then pick your funds.
The similar question goes for the debt investment as well. What should be the strategy, and what things to keep in mind while going for a debt investment?
Yes. So, first and foremost, it becomes important here that you understand why do you really need debt in your portfolio. So you could need debt because you have a liquidity requirement over the next few months or maybe 1, 2 years. It could be to bring down the overall risk of the portfolio, which means, the volatility that comes in because of equity, you want to balance that out. So you're having some debt allocation. The second point, or the volatility point to a certain extent can be managed by having a longer time horizon. So if you have a, let's say, 10-year time horizon, then you need very little debt in your portfolio because equity over a longer time period stabilizes. But if you're looking at a 3-year track record, then you may need to have maybe a 20-30% of debt. So why are you choosing debt in the portfolio? And that will help you pick your categories. So, for example, if I have someone who's coming to me and saying, I need debt because I will need some money at the end of 1 year, then you can go in for categories like, a money market fund. You can look at a short term fund, or you can also look at an arbitrage fund today. Because from a taxation standpoint, an arbitrage after a 1 year holding period would be far better than having a pure play debt fund in the portfolio. Likewise, if you're looking at, let's say you have a certain specific year in your mind that I need money by 27 or 28, then you have target maturity funds that are available, which is, far better in terms of credit quality because you're directly buying a government paper there. It gives you a visibility of return. You're trading at around the 7% of yield. So deciding your tenor, deciding why you want debt will help you pick your categories. I just gave you, 2 examples here.
Sure, but lastly, Shweta, I wanted to have your take that why should one avoid the hybrid funds and the multi-asset allocator funds? Why should they not go for it? What are the cons there?
Yes. So I'll tell you there are two factors here. One, in a multi-asset fund or a hybrid fund, what we've generally seen is they tend to have equity, which could be anywhere in the range of 40 to 70%, and the rest of it is debt and, like I said, commodities. This asset allocation, what the fund manager is following, looking at the general, his view on the market may not be what you really want. You may have a 10-year horizon and you may want to have an 80% equity in the portfolio. So your asset allocation strategy does not match necessarily with what the fund manager is going to follow for you. Second, again, within equities, like I said, you may want to go in for a 50% large, 50% mid and small, but the fund manager is more following a large cap oriented strategy. That again, does not match with what an investor should ideally do in a given scenario. So these are two inefficiencies that a multi-asset or a hybrid fund brings in, and which is why we've seen that having a pure play equity debt tends to be better than multi-asset. Yes, I've also heard people coming back to me and saying, but you can get debt at a lower taxation because most of it could be taxed like equity. You're clearly tax should not be your determining factor for taking your investment decision. It should be more as to what strategy leads you to your return. Today, you also have arbitrage options, which are like debt for you to a certain extent and are taxed at 10%. So that can be managed very well. But just getting your asset mix right and your market cap mix right, which is relevant for your portfolio and your strategy, cannot be done in a multi-asset or a hybrid fund. This is where I would suggest, a pure play equity and debt rather than a multi-asset.
All right, Shweta, thank you so much for joining us today for today's discussion and helping our viewers understand that how can these pure play equity and debt side of the investments can reward them better in comparison to the hybrid funds. Thank you so much. Really appreciate your time and joining in with us. We have Shweta Rajani of Anand Rathi to help you all better. And Shweta, great to have you. And let's go on with our first caller that is already connected. And we are being joined by Sundar from Chennai. Hi, Sundar. Very good evening. And thank you so much for calling us. We have Shweta online. Please go ahead and ask your question.
So I have US 64, I'm sorry, Axis Focus 25 fund for almost close to 8 lakh rupees. I'm running into losses, but I don't know. So do I need to continue this or?
Okay. So, Sundar, you have been investing in this fund for the last 5 years through an SIP route. Did you go ahead with, or that was a lump sum money of 8 lakhs that you have put in?
Good, but staggered investment over a period of 5 years.
Okay. Shweta, he is in a loss and he has invested in Axis Focus 25 fund. Should he continue holding this one, because it's been 5 years that he's been investing in this and he's at a loss? So what will be your advice?
Yeah. Sundar, my advice to you would be that you need to exit from this fund clearly, because Axis itself, we've seen it's gone through a lot of changes in terms of the fund management team, their fund strategies. So it looks like, till the time the fund stabilizes, it may take some time. So shifting out even at a loss and entering into another fund, your recovery may be faster. So I would suggest you to go in for, I'll give you names of one or two funds. You can invest in them. So you can go in for, maybe an HDFC Flexi Cap fund, or you can go in for a Kotak Multi Cap fund. I don't know how many funds you already have in your portfolio. So against one scheme that you're exiting, I've given you options of two names. Now, also I want to highlight that, see, while you are exiting it at a loss, sometimes having a loss in the portfolio is also a good thing, because you can carry it forward for the next few years. And in future, whatever gains you make in the equity, you can offset against those gains. So you can consult your CA and he'll guide you exactly on this. But exiting even at a loss may be a good thing for you, because the recovery in another scheme looks to be better than Axis Focus.
Okay, Sundar, so that's the advice coming in for you. Do consult your CA to save some taxes out there, as well as Shweta also shared the top ideas that you can look out for. Thank you so much for calling us, but let's move on to another query that I have coming in. And Shweta, this one is an email query coming in from Alicia, and she says that she's quite new to investing, and she's looking at to start her journey with an SIP of 6,000 rupees a month. How to go about it? Any top ideas that you can help her with? Any schemes, and how to take a decision that between large cap, flexi cap, small and mid cap, there are a lot of varieties of mutual funds that are available, which one to pick out from? And she also has multiple queries related to this, that in next 3 years, what should be the expectation, when to feel that it's the right time to take out the money. So what will be your advice for her, Shweta?
Sure. Aisha, firstly, congratulations. I would say you've taken a right decision. You're starting your financial journey and you're doing it through the right asset class. This is very important. So, congratulations for that. Now, see, first and foremost, I would say it becomes very important that you set your goal, right? You're starting with 6,000 rupees today, but do you really need the money after 3 years? Because you're asking what you could expect in the 3 years. You're starting off now. If you don't have any liabilities, set your goals. Maybe you want to buy a car after 3 years. So how much money would you need? Maybe you want to buy a house after 5 years. So how much money do you need for that? And then take a step back to see how much SIP do you really need. This will help you to, not do a sudden exit or a panic exit. Also to stay put, not worry about market peaks and market lows. So it's important that you set your goal. Second, you asked about SGBs. That brings me to the point of having the right asset allocation in the portfolio. If you have a time horizon, which is, I would say, more than 5 years plus, and I think you should have that since you are just starting off, you can have up to an 80% equity in your portfolio. That will help you grow the compounding effect. You'll see how you benefit out of it. 20% of it can be debt. Now that debt includes if you're working, your EPF, PPF, everything. Only buy gold if you need it for consumption. So you think you're going to get married after 7 years and you would need gold, then go ahead for an SGB. Otherwise, I don't think you need it in your portfolio. Within equities, again, you raised questions on what categories should you go in for. I would suggest you a basket of, 5 to 6 funds. You can start off with some of them now, and as your money grows, remember one thing: every year, as you see a salary increase, step up your SIP. As you see some bonus coming in, do go in for a lump sum investment. So some funds that I would suggest, go in for an HDFC dividend yield fund, go in for an Aditya Birla multi-cap fund. You can go in for a DSP equity opportunities fund, and you can go in for an Aditya Birla small cap fund. I've given you a combination so that you get a good blend of large, mid, and small in your portfolio.
So that's the advice coming in for Alicia. But the next viewer is Anandita, and Shweta, she says that she's 33 years old right now, and she wants to plan her investments for the next 20 years. She's already putting in some money in 3 funds, I believe, wherein SBI Focus Fund, Tara Small Cap Fund, and Parag Parikh Flexi Cap Funds are the funds wherein she's right now, I believe, is putting 2,000 rupees a month each. And 2 questions. She wants to know that what corpus can these funds get her in the next 20 years, as well as she might also need some funds for the 20-year investment planning.
Sure. Anandita, one thing that's good is you're very clear on your investment horizon, that you're not going to be needing money for the next 20 years. If you go with the current SIP, and I've taken a 14% rate of return because that's historically that's a very possible return from equities. So 6,000 monthly SIP would take you to somewhere around 80 lakhs over the next 20 years. So see if that helps you achieve your goal. If no, then you can step up your SIP, or whenever you have some lump sum, go ahead and invest that. Out of the 3 funds that you mentioned, I would say you can continue with the SBI Focus Fund. The fund went through a rough patch, last year. We've seen some amount of recovery also taking place. So you can continue with that one fund. The other 2 funds that you have, Tata Small Cap and the PPFAS Flexi Cap Fund, I would suggest you to stop your SIP in them. There are better funds available, I would say, and the Parag Parikh Fund has some bit of an international equity exposure, being right now in a pure 100% domestic equity would play better, as India has, India's far better placed than a lot of other countries. So some funds that, therefore, I suggest for you in the portfolio, you can go in for, within SBI, you can go in for an SBI large and mid cap fund. That again is a good fund. Go in for an ICICI Focus Equity Fund. You can go in for a Quant Active fund in your portfolio. So Quant Active is multi-cap, iProve Focus, and so having a combination of 3-4 funds should be good enough for you.
That's the advice coming in for Anandita. But with this, Shweta, we'll let you go on that. Thank you so much for joining us today and helping all our viewers with their portfolio-related queries and guiding them in the best way. But with this, viewers, it's time to wrap this edition of The Money Show. It's a goodbye from me and the entire team who put the show together. Thanks so much for watching.